Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending June 13th, 2025. So the title of the review this week is Geopolitical Risks Rising. So 2025 has been a very eventful year with the Trump administration, the trade policy, tariffs on and off. There was always some geopolitical risks in the background internationally, of course, with the Gaza Strip, with Israel. But there were some risks that were being discussed recently that Israel might go after Iran because of its nuclear program, and the global observers saying that there was a risk that Iran was working on building its nuclear capacities, on the side. So all of these conversations, came to a head, and no one really, well, not no one, but the consensus in the market was that likely Israel was not gonna be doing anything anytime soon. But they went against the grain and surprised everyone with a strike on a Thursday night. Those strikes are still ongoing today, and we're hearing from Israel that it could go on for a few days. There's been some retaliation by Iran, mostly through drones, but now everyone's just wondering what's going to happen next, what's going to be the reaction of Iran, how can they retaliate on that, who will they retaliate against, Israel directly or through proxy countries or on US facilities. So it's going to be again a complicated period ahead of us. So of course the impact of all that on the market is negative, but rather muted, I would say. This morning when we were looking at everything, the price of oil is the main driver here. It's up. But it was up about 14% at some point late Thursday night. This morning, on Friday morning, prior to market open, as I'm recording this, prior to 9:30, the price of oil is up about 8%. So there was some cool down there. Equities are of course negative, but it's not cataclysmic yet either. Interest rates are up rather than down, so the safe haven role from bonds is not the one dominating the market today. It's more about the likely inflationary pressures coming from higher oil prices. So market is trying to digest that, but of course that just adds to the climate of uncertainty and potential volatility in the market. So if we look at this week's markets at the close on Thursday, so everything here might change drastically by the end of the day. You have higher rates, so you have negative returns for bonds, so that should flip. Equity returns that we've had this week, mostly positive, likely they're gonna flip to negative. Emerging markets were up 1.5, maybe we'll end the week in a positive territory here, but we'll see. Price of oil was already up 5.4% on the week at 68 bucks. This morning it's getting closer to $75, so that should be a very solid week for the price of oil. The USD continued to weaken through the week based on everything to do with the loss of the US exceptionalism trade, the lack of interest for the marginal dollar in US assets. So all of this thesis that we've discussed often and often, but now this morning we see that the USD is playing its role as a safe haven, so it's reversing some of those trades. And the price of gold continues to rise. This morning it's up about 45 bucks, so more than 1%. So the gold continues to play a very key role in portfolios in 2025. Now, an update on tariffs, because there's still some interesting things going on before we go to the Iran-Israel situation. So what we heard this week from CBC is that Canada and the US, the talks are intensifying, and there's a document that's going back and forth between the two countries for an outline of a deal on a trade, on security. So this is a very positive development. Likely, if we look at what happened with other countries, like with Mexico, with the UK, likely the tariffs on steel and aluminum could be negotiated away. The UK, that was an integral part of the deal that they struck, well, the outlines of the deal that they have with the US. Mexico, we're hearing rumors that also they are negotiating something, and that would remove those tariffs. So we need to extrapolate here and think that likely this is going to to happen for Canada as well. Remember that the tariffs on steel and aluminum in the US are more detrimental than positive, because production of steel and aluminum are very small parts of the US economy, but the sectors that consume steel and aluminum to produce consumer good, investment goods, defense goods are much more important in the US. So you're hurting the consumers of the commodities to help a very small part of your economy. So it doesn't really make sense. So those are very likely candidates to be part of the negotiation here. So we'll see what happens, but it's good news that we're hearing. But on the other end, we're still hearing that the automobile tariffs on Canada could increase. So Donald Trump does seem to have a thing with the car sector, the auto sector. So that could be something that remains. But let's see if this is also part of the negotiation. Everything that we're hearing now. On the right, you have that Trump says that he will set unilateral tariff rates within weeks. So remember, Liberation Day, April 2nd, big tariffs on everyone, then a pause announced for 3 months, which ends on July 9th. And now Donald Trump is saying that, well, there's too many countries to negotiate with. We can't do all of this. So we're going to be sending letters to countries and say, well, this is the deal, this is the rate, this is the cost of doing business in the U.S. So Liberation Day redux seems to be just about to happen. So let's see if it's another one of those deadlines that that's just pushed back and back. But so far, if you look at purely the information that we have, there's a risk that we return to the environment that we had prior to April 9th, with now the markets having pretty much discounted any part of that, thinking that this is all just negotiation tactics. This is going to be negotiated away. So that means that the market might be vulnerable to trade shock once again. So this could be very important in the coming weeks. Now for geopolitics, turmoil in the Middle East. Of course, we could. This is something that we've seen, multiple times in the past. But now this is a very serious event with Israel attacking Iran's nuclear facilities, killing top military leaders, an operation that could last for days. Iran has faced multiple losses over the last months or quarters, with a loss of influence, with the proxy wars that we've seen with Gaza, Hezbollah, in Lebanon. So there's been lots of things happening there. So now so the question is how Iran will react. So will they start hitting Israel directly? Will they start hitting U.S. facilities? Because the U.S. did not caution this, but of course they were informed of this coming. So maybe Iran will go after the U.S. So you see all of those scenarios here that could be detrimental. Will Iran want to close the oil shipping routes that are like that are just in its waters? Many things can happen that could push, of course, geopolitical risks higher, but also that could push the price of oil much higher from here still. And of course, with the price of oil being such an important driver of purchasing power around the world, of inflation, so that could have some far-reaching implications for the market. So looking at inflation now, that was the data from the week, inflation in the US. So CPI year over year is slowing down. The last 3 months annualized, the chart on the right, you're seeing that it was slowing down quite strongly as well. So that was good news on the week, but pretty much every forecaster out there is pointing towards the next few months as an acceleration in the price of core goods. So the goods that are influenced by the tariff rates that are in place, because you do have a baseline 10% on most countries around the world. Of course, you have a 55% on China. So you do have lots of tariffs out there, strong tariffs rates. Now, if you have an inflation in core goods, what is the forecast now is that it should go from 2% to about 5% by the fall for core goods. So that's plus 3% on about 20% of the overall CPI basket. So 20% of 3% gives 0.6. So now inflation is at 2.4, so that could go all the way to 3% by the fall. So this is what that means. And also, if you add the impact of higher oil prices, if it sticks, higher gasoline prices, that could continue to push inflation higher. And of course, that puts the Fed in a tough spot. And again, the Fed seems to be boxed in. So if you go to the last slide here, what's priced in for the Fed by the end of the year. The first cut is priced in for September, about 90% odds that we have a cut in September, and then another in December. So that's 2 cuts by the end of the year. So will the Fed be able to cut that much? We still think this is an optimistic scenario, that the Fed is likely to face rising inflationary pressures. Yes, you can look through some of those, but you want to make sure that inflation expectations remain well anchored. And so far, inflation expectations are starting to get to rise depending on who you ask, but especially if you ask consumers and businesses, it's higher. If you look at the pricing in the markets, the break even, they're well behaved still, but the surveys are telling another story. So the Fed is in a difficult situation. So next week we have a decision by the Fed. The language will be very important. No one is expecting any change, pretty much 100% odds that the Fed will stay put next week. But the language will be very important on the next steps and to assess if it's reasonable to expect 2 cuts by the end of the year. This will be the focus for market participants next week. Now, what we'll be watching next week in the data, in Canada, we'll have housing starts and retail sales, so very important macro data to assess the health of the Canadian economy. In the US, housing market is slowing down because of a higher interest rate. So housing starts, building permits will be giving us a reading. And for the Fed, no change expected. That's going to be on Wednesday afternoon, the most important data point of the week. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content here, please share. And of course, come back again next week.